The subject of this video is whether a concern that intermediate and longer term bonds have started a long-term bear market trend is justified. I am including some citations in the More section below where you can find some of the data that I will be citing in this video. I was looking this morning at a 30-year Treasury bond chart that starts in February 1977. This chart can be found at the St. Louis Federal Reserve's website. The chart displays the 30-year bond yield at the end of each month, so this is monthly data, not daily data. The first number is 7.8% for the month ending in February 1977. Annual CPI, consumer price inflation, was reported at 5.7% in 1976, which was down from 9.1% in 1975, which was largely due to the oil price shock of in 1974. But then CPI rose to 6.5% in 1977 and even higher in 1978 at 7.6%. So the trend was moving back up into the late 1970s. Inflation was responsible for that much higher yield in February 1977 compared to the 4.58% yield at last Friday's close for the 30-year Treasury bond. For those unfamiliar with the economic history of that earlier period, inflationary pressures started to build in the late 1960s when I made my first stock purchase, and those pressures accelerated through the 1970s and into the early 1980s. By September 1981, the 30-year Treasury bond could have been bought with a 15% yield. The annual CPI increases were reported at 11.3% in 1979, 13.5% in 1980, and 10.3% in 1981. Those are annual increases in CPI. Starting in 1982 through 2020, largely as a result of the Federal Reserve crushing inflation, the CPI numbers started a very long-term trend down. The chart of the 30-year bond yield reveals what I describe as a long-term bull market in bonds that's reflected in lower yields until the 30-year in 1920 hit 1.28%. The trend since then has been persistently higher for several reasons. When I built my home and where I now reside in 1982, I paid cash for everything since the 30-year mortgage rate was over 16% with a couple of points added to that number. Intermediate Treasury notes and bonds did not start a bear market in the 1960s when inflation started to surge into problematic territory. Instead, I traced the start of that bond market to around 1950, and that long-term bear market lasted until mid-1982, or about 32 years. The bond bull market that started in 1982 may have ended in 2020. In the long-term chart of the 30-year bond since then is consistent with what I would characterize as the early stage of a long-term bear market, similar to what happened starting in the 1950s. The kickoff for the 30-year bond bear market after World War II occurred as consumer demand had been suppressed during the war and was unleashed into a massive spending spree. Annual consumer price inflation was reported at 1.6% in 1944 and 2.3% in 1945. Over the next 3 years, annual CPI growth was reported at 8.5%, 14.4%, and 7.7%. So how did the Fed respond to those inflation numbers? Did they increase the Federal Reserve, increase the federal funds rate? No. The response was similar to what happened in 2021 as inflation started to soar. The Fed engaged in monetary stimulus in the period after World War II by forcing the 10-year Treasury yield down below the inflation rate. And that kind of monetary stimulus drove the 10-year yield down below 2.5%, notwithstanding these high inflation numbers. And the short-term rates during that period were even lower than that 10-year Treasury yield, notwithstanding the inflation numbers, which were extremely high. That period of interest rate suppression by the Fed and the government is discussed in a NBER paper titled Before the Accord, Monetary Policy 1945 to 1951. Yes, as proven by that era from 1946 to 1951, the Fed can lower inflation, the interest rates below the inflation rate, as it did in 2020 and 2021 and into 2022. The problem is what happens after the Fed ceases to create negative real yields by interest rate suppression and just quits doing so. The first reaction is that the Treasury note and bond yields start to adjust to normal spreads to the anticipated inflation rate, which is about 2% for a 10-year Treasury note. That's generally what I would expect to see without the Fed manipulating that rate. So that would be taking the break-even inflation rate of the 10-year tip and adding 2% to it. That would give me about a 4.3 or 4.4% yield on the 10-year Treasury note using a 2.3% break-even inflation rate and a 2% spread. What if I had bought a 10-year Treasury note with a 2% yield in 2021? It would have to go down in price until it hit a 4.3% yield or thereabouts. And that is would have to be a significant price decline in order to get that, what is in effect the market yield now. And that is what can kick off a long-term bear market in bonds, a process that I call interest rate normalization, which occurs after a long period of interest rate suppression by the Federal Reserve and excessive monetary stimulus by the Fed. The Fed ended its QE policy in 2022 that resulted in its balance sheet soaring to over $7 trillion. The program was successful in pressuring long-term yields below the inflation rate for a long period. The Fed is only starting to gradually wind down its bloated balance sheet, and that is occurring at a time when the Treasury has to sell a gargantuan amount of new debt to pay off what is maturing and to finance the budget deficit, which was $1.7 trillion in the fiscal year ending in September 30, 2024. Another problem, potential problem in a supply-demand imbalance for U.S. government debt is that one or more foreign government buyers of treasuries, which includes China, may be less willing to fund U.S. budget deficits going forward, particularly if Trump raises tariffs on China's exports, which he plans to do. The supply of new treasuries will in time overwhelm the world's appetite for buying buying the supply that has to be issued, at least at low interest rates by historical standards, and yields will start to have to increase irrespective of inflation expectations over the term of the debt. And inflation expectations are, in my opinion, too optimistic now, as reflected in the break-even inflation rate of the TIPS. The bottom line is that there are reasons to be concerned about a long-term bear market being in its early stages now, similar to what happened starting in the early 1950s and gathering momentum in the 1960s. But potentially it could happen much quicker now and become worse down the road, given the amount of debt in the system as a percentage of GDP compared to that earlier period. No definite conclusion can be formed that intermediate and longer-term bonds have already started a long-term bear market, but the trend is consistent with a start, as are the economic conditions likely to prevail over the next several years and the extremely high debt levels in the U.S., primarily the federal government, but also extending to consumers, corporations, and state governments. And in other words, there's just too much supply out there that has to be refinanced. The statement recently made by the hedge fund manager that Trump has appointed to be Secretary of the Treasury, that it was absurd to be worried about Trump's policies stoking inflation, did not ease my concerns at all that they were inflationary. I do not like where this is heading, but recognize that there is nothing that I can do to prevent it. Given my age and financial circumstances, I'm going to keep my bond ladder weighted at the short end, with about $100,000 to $130,000 in maturities each month, with my longer-term maturities being primarily Tennessee municipal bonds rated AA or better. I live in a city, Brentwood, Tennessee, which has a AAA credit rating, as does my county, Williamson, and the county seat of Williamson County, which is Franklin, and my state. So I'm using those high-quality municipal bonds just in case I'm wrong about the future course of interest rates being up.